The year is 2026. The world is shutting down. Planes are grounded. Restaurants are empty. 40 million Americans file for unemployment in 8 weeks. And somewhere in Connecticut, a hedge fund manager is having the best quarter of his career. His name is Bill Ackman. And in March 2026, as the S&P 500 was collapsing in real time, he sat in front of a camera, looked directly into it, and said, with what sounded like genuine distress, "Hell is coming." Markets tanked further. What he did not mention in that moment was that he had already placed a bet, a very specific, very large bet, that markets would collapse. He spent $27 million on that bet. It paid $2.6 billion. In 3 weeks. That is not a typo. So here is the question this video is going to answer. Not, is that legal? It is, mostly. Not, is that fair? That is not the kind of question this channel asks. The real question is, how does that happen? What is the mechanism? What is the system that allows a crisis to be simultaneously a catastrophe for most people and a wealth-generating machine for a very specific few? Because it is not luck. It is not even just money. It is structure.
Here is something worth understanding before we go any further. We are living in what economists are calling a perma-crisis era. That is actually a word now. It won the Collins Dictionary Word of the Year in 2022. It means a prolonged period of instability and insecurity. Since 2008, we have had a global financial crash, a sovereign debt crisis in Europe, a pandemic, a land war in Europe, a banking mini-crisis in 2023, a regional conflict in the Middle East with global supply chain consequences, and persistent inflation that central banks are still trying to contain. Each of these events created enormous suffering for ordinary people. Each of them also created enormous wealth for a small number of actors. That is not a conspiracy. It is a pattern. And patterns, unlike conspiracies, can be explained. So let's explain it. To understand how people get rich from crises, you first need to understand one concept: volatility. In financial markets, volatility is not just another word for things going up and down. It is a measurable thing. It has a price. You can buy it and sell it. When markets are calm, volatility is cheap. When markets are terrified, volatility is expensive. There is an index called the VIX, the volatility index, sometimes called the fear gauge. When everything is normal, it sits around 15. When the world is on fire, it spikes to 80, 90, even higher. And here is the thing almost nobody talks about. A crisis does not just move asset prices, it moves the price of uncertainty itself. That is a separate market, a massive one. The derivatives market, the market for options, swaps, futures, all the instruments built on top of regular assets, is worth over $600 trillion notionally. That is roughly 6 times the entire global GDP. Most of that market exists to manage risk. But risk management tools, by design, become most valuable exactly when risk is highest, which is to say, exactly during crises. So the first mechanism is simple. Crises are demand spikes for financial instruments that are cheap to acquire in calm times and extremely valuable in chaotic ones. If you hold the right instruments going into a crisis, you win. If you're trying to buy them after the crisis starts, you were already too late, and you were probably buying from someone who bought early. Now, you might be thinking, but no one knows when a crisis is coming. That is what makes it a crisis. And for most people, that is absolutely true. But there are categories of actors for whom that statement is significantly less true. Let's talk about three of them. The first category, people with information flow advantages. Not insider trading. That is illegal. And also, the returns from actual insider trading are surprisingly modest compared to what we are about to discuss. What I mean is structural information advantages. Large financial institutions process enormous amounts of data. Credit card transaction data, satellite imagery of parking lots, supply chain invoicing patterns, employment filings. A major bank does not just read the news. It observes the economy at a resolution that no individual can match. When COVID was spreading in Wuhan in late 2019 and early January 2020, before most Western governments had even acknowledged a potential problem, certain institutional investors were already repositioning. Not because of leaked classified reports, because they were watching freight data from Chinese ports, tracking pharmaceutical company R&D movements, and monitoring hospital supply orders. That is not illegal. That is just having better instruments. The second category, people with structural short positions. A short position means you are betting that something will go down in value. In normal times, shorting is uncomfortable. You pay interest on borrowed assets. You have unlimited downside if the bet goes wrong. Most retail investors cannot do it at all, practically speaking. But for certain hedge funds, large short positions are a core strategy. They spend years building theses on fragile systems, overvalued real estate, overleveraged banks, governments running unsustainable debt. They just sit and wait. Michael Burry, the investor made famous by The Big Short, began accumulating short positions against U.S. mortgage securities in 2005. He held them through enormous losses, enormous pressure from his own investors for almost 2 full years. When the crisis hit in 2007 and 2008, he made $700 million for himself and $2.69 billion for his investors. The crisis did not create his opportunity. The fragility was always there. He just identified it before it became obvious. The third category is slightly different, and in some ways more interesting. These are the people who profit not from anticipating the crisis, but from the policy response to it.
This is the part that does not get enough attention. When governments respond to a crisis, they inject enormous amounts of money into financial systems. They cut interest rates, they buy assets, they pass stimulus bills. This creates a second wave of wealth transfer, and it is much larger than the first. Think about what happened after 2008. The U.S. Federal Reserve cut interest rates to essentially zero and kept them there for 7 years. They also bought trillions of dollars of assets through a program called quantitative easing. The intent was to stabilize the economy, and in some ways, it worked. But the mechanism of that stabilization was making financial assets more valuable. When interest rates are near zero, bonds yield almost nothing. So investors move money into stocks, into real estate, into anything with a higher return. Asset prices inflate. Who owns most of the financial assets? The wealthiest households. In the United States, the top 10% owns roughly 89% of all stocks. So when the Fed's crisis response inflated asset prices, it predominantly enriched the people who were already wealthy. Between 2009 and 2020, the S&P 500 rose by roughly 400%. U.S. median household income over the same period rose by about 18% in real terms. That gap is not a coincidence. It is a consequence of which tools governments have available and which populations those tools predominantly reach.
Let's get more concrete, because the abstract version is interesting, but the specific version is revelatory. Mechanism 1. Commodity arbitrage during supply shocks. When a crisis disrupts supply chains, commodity prices spike. Oil, grain, metals, semiconductors. Anyone who had existing contracts to buy at pre-crisis prices and sell at crisis prices captured the spread.
During the 2022 energy crisis triggered by the war in Ukraine, certain European gas traders made extraordinary returns simply because they had contracted for long-term LNG supply years earlier when prices were low and were now selling into a market where desperate buyers were paying 10 times the normal price. The crisis did not give them the contracts, it just revealed the value that was already embedded in them. Mechanism 2. Distressed asset acquisition. During every major crisis, assets trade at extreme discounts because sellers are panicking or forced to liquidate. Banks close, properties foreclose, companies go bankrupt. After 2008, private equity firms and well-capitalized investors bought enormous quantities of distressed real estate at fractions of their pre-crisis value. Single-family homes, commercial properties, entire loan portfolios from failed banks. Those assets subsequently recovered in value over the following decade, and the people who bought them in 2009 and 2010 made extraordinary returns, not because they created anything, but because they had liquidity when no one else did. Access to capital during a crisis is itself a form of advantage, and access to capital is not randomly distributed. Mechanism 3. Regulatory capture and crisis contracting. This one is less discussed in financial circles and more discussed in political economy, which is probably why it does not get the coverage it deserves. During major crises, governments rapidly deploy enormous sums of money. Procurement rules are relaxed. Contracts are awarded at speed without the usual competitive processes. During COVID, tens of billions of dollars in contracts were awarded in the US and UK to suppliers with limited track records, political connections, and in several documented cases, no relevant experience at all. This is not conspiracy theorizing. These contracts are public record. Multiple government audit bodies have produced formal reports on the subject. The mechanism is crisis creates urgency. Urgency compresses decision-making. Compressed decision-making benefits people who are already positioned inside the network of decision-makers. That network is small. It has always been small.
Let's zoom out and look at what actually happens to wealth distribution during crises. Every major financial crisis of the last 100 years has, in its aftermath, produced a measurable increase in wealth concentration at the top. The 1929 crash wiped out enormous middle-class wealth in stocks and real estate. By the mid-1930s, the wealthiest Americans had largely recovered their position. In some cases, enhanced it. The middle class took decades longer. After 2008, U.S. household net worth dropped by about $13 trillion. That is a staggering number. By 2012, the net worth of the wealthiest 7% of Americans had recovered fully. The net worth of the bottom 93% had declined a further 4%. These are Federal Reserve numbers. After COVID, the pattern was even sharper and faster. The world's 10 richest people doubled their wealth during the first 2 years of the pandemic. Global extreme poverty rose for the first time in decades. The mechanisms we discussed explain both of those things simultaneously. They are not separate stories. They are the same story, told from different positions in the financial system.
At this point, someone in a finance context would offer the following argument, and it is worth engaging with seriously rather than dismissing. The argument is this: liquidity providers, short sellers, and distressed asset buyers are actually providing a service during crises. Short sellers expose overvalued companies and fragile systems before they explode, potentially limiting how bad the crash gets. Distressed asset buyers provide a floor under falling prices, preventing a full collapse into nothing. Liquidity in derivatives markets allows real businesses to hedge their risks. This is not wrong. These functions exist. They have value. But here is where the argument breaks down. The scale of the returns does not match the scale of the function. If a hedge fund manager provides a risk management function and earns an 8% return for their investors, that seems commensurate with the service. When that same function returns 9,600%, the math on Ackman's trade, you are no longer describing a service fee. You are describing a structural extraction.
And the structure that enables that extraction did not arise naturally from free markets. It was built by lobbying, by regulatory choices, by decades of decisions about which financial instruments would be permitted, which markets would be regulated, how much leverage would be allowed, and who would have access to what. The rules of the game determine who can win, and the people positioned to profit from crises have historically had significant influence over what those rules look like. That is not the market. That is politics, wearing the market's clothes.
So, what does all of this mean? Here is the uncomfortable implication. Crises are not temporary interruptions to a normal system. They are stress tests that reveal what the system actually is underneath the stability. And what we see consistently, every time, is that the system has significant asymmetry built into it. Downside risk is broadly distributed. When a financial crisis hits, unemployment rises across the economy. Small businesses close, ordinary people lose savings. The pain is wide. Upside recovery is narrowly concentrated. The tools available to exploit the crisis and then to exploit the recovery from it are disproportionately accessible to actors who are already wealthy and well-connected. That asymmetry does not just produce inequality as a side effect. In a meaningful sense, it produces crises. Because a system in which private gains from risk-taking are unlimited, while the social costs of failure are distributed broadly, creates incentives to take on excessive risk. That is the core logic behind the 2008 financial crisis. Banks made enormous bets. When they won, they kept the profits. When they lost, governments, meaning taxpayers, absorbed the losses. The people running those banks are, in most cases, still wealthy. The people who lost their homes in the foreclosure wave are, in most cases, still recovering. The system was not broken in 2008. The system worked exactly as designed. The design was the problem.
So let's come back to Bill Ackman. After his pandemic trade made $2.6 billion, he used much of the proceeds to buy heavily discounted equities, stocks that had crashed, which then recovered over the following 18 months because of the exact policy response we described earlier: near-zero interest rates, quantitative easing, government stimulus. He made money on the crash, then he made money on the recovery from the crash. Not because he is unusually intelligent, though he is clearly not unintelligent. Not because he works harder than anyone else, though he may work quite hard. Because he is positioned inside a system that, during moments of maximum disruption, routes capital toward people who already have capital. That is what crises do. Not because crises are designed that way, but because the systems they reveal were designed that way. And here is the question this leaves you with. Every few years, there is another crisis. Another war, another pandemic, another financial shock, another moment of fear and uncertainty. And every time, the pattern repeats. By now, you have to ask, at what point does a pattern stop being a coincidence and start being a feature? Because if it is a feature, if this is what the system is supposed to do, then the question is not how to survive the next crisis. The question is who decided the system should work this way, and whether anyone is actually trying to change it.